All right, so we are back to the chat. Sorry, I had to do quite a lot of things. So, all right, so let's get back to John. Okay, so we see that John had taken a trade at that point. All right, the stop loss is usually below 78 to 100, and then he takes his entry at the middle of 50 and 61, and he makes use of a pending order primarily. So we see that this trade went in his favor. All right, in this case, we see that there's a break of structure at that point. We would have taken a trade at this point here. We would have taken a trade at this point, which is here. And then stop loss would have been in the middle right there. And then targeted risk reward ratio of 1 to 3. Unfortunately, this trade did not go in his favor. It went in his favor though, but we stopped him out. Think about a few pips before it went in his favor. Now, the question now is now we know where to enter a trade based on John's strategy. We know where to exit a trade based on our risk to reward ratio. Now, the question is, how do we know where we should what lot size to use? And that's the main reason for this video. What lot size am I going to be making use of? Now, this is where you make use of the my FX book. All right, my FX book. Go to myfxbook.com and then you will see position size calculator. All right, now when you go to the position size calculator, you want to, in line with your strategy, you want to know what lot size, what stop loss, what is the stop loss you are using. Now, if you click on this, you'll notice that your stop loss, now don't assume a stop loss. What people do is that they just assume, let's say my stop loss is 10, and then they make use of random lot sizes, which is not supposed to be. As a trader and as a risk manager, you want to ensure that your stop loss is also in line with the amount of money that you intend to risk, which will now give you the right lot size to make use of. So we see that our stop here for this trade is 6. And don't forget, what's his name? John was trying to, is risking $50 on this trade. All right. Now, what I want you to do, there are 2 ways you can go about it. You can either put $5,000 here. All right. And then you risk 1% of $5,000. Well, I always try to make it things easy. So let's say you are risking $50. This is $50. You risk 100% of $50. Your stop loss is 6. Right? Trade size lots is 1. All right. Don't forget your currency pair. The currency pair that we are trading in this case is AUD card. As you can see, this is AUD card. It's AUD card pair. Yeah, it's AUD card. As you can see right there, AUD card. So we come to our position size calculator and then we click on AUD card. So once you come, think all right, so we have AUD cards right there, and then you calculate. And so once you do your calculation, you will see the lot size that you are going to be making use of in this case is 1.12. All right, so that's your lot size for that trade because you are using a 6 pip stop loss, and then you are trading a $50, risk per trade. All right, now in the case of this, let's look at our first trade. What do we see here? Our lot size is, our stop loss rather is 8.5. So we come here, since we are trading AUD card, we are going to be making use of AUD card, and then our stop loss is 8.5. We are still risking $50, and our risk ratio is 100. All right, so what do? We calculate right then. So once you calculate, you see the lot size 0.79. So this is what you're going to put into your MT4 or your MT5 or into your brokerage trading platform, and then you can now trade, knowing that if the trade ends in a loss, you're only going to be risking $50 per trade. Now let's look at John again. All right. So, but before then, let's see this. All right. So for those of you who were able to get the answer right, if you took 50 trades and you had a 30% win rate, you would have won 15 trades. So now let's look at John's trade. Now John is risking $50 on a single trade, and then with the risk reward ratio of 1:1, he made $50. He's risking $50 for $50. And the risk reward ratio of 1:2 is risking $50 for 100, and so on and so forth. Now, in this case, look at John, and we see that John is risking $50 for $150 because his risk reward ratio is 1:3, and he has a 40% win rate. Now, take a look at this. This is 15 trades, 40% win rate, and 1:3 risk reward ratio. Those are the things that you want to pay attention to. The number of trades you are taking, your win rate, and then the risk reward ratio. Now, if you notice, you see that these are 15 trades. And based on what we checked out before, we noticed that out of 15 trades, if you have a 40% win rate, you can go back and check it. You see that you win 6 trades out of 15. So we see John won the first trade here, second trade here, third trade here, fourth trade here, fifth trade here, and sixth trade here. Now, if you do your calculation, all right, I don't want this video to be so long. If you do your calculation, you notice that this will be the end result of your calculating all of this. Multiply 150 times 6 will give you 900, I think so. And you multiply 550 times 11. I think that should give you somewhere around 950. That should give you somewhere around 11 times 50 should give about 550. So 900 minus 550, you are ending in profit regardless. So we have $350 in profits. Now, this is how you do your calculation, right? Now we have checked out how to, manage our risk, all right? We have checked out how to manage our risk. We have talked about strategy, how you can take your trade based on a particular strategy using your stop loss and going to the MyFXGO calculator, calculating and then entering your trade and then waiting for your trade to play out. All right. Now, the very important thing I would like to make known, which is a bonus tip, is that many times than not, we as traders, when we go through times of losses, we forget to pay attention to the big picture. Now, this is the big picture, and this is a month. Let's say this is a month, 15 trades in a month. Now, let's say you take the first trade here on the 5th, you took a trade here, you lost. On the 6th, you took a trade. On the 7th, you took a trade and you lost, the first three trades that you took. It's most likely you're going to begin to get annoyed, get upset, and you may begin to do take some emotional mistakes, which can cause you to now lose your account. So it's important that you stay consistent. John is a disciplined trader. He knows how much he's risking. He has some money in his bank account, which allows him to trade responsibly. And then he knows how much he's risking per trade. He knows how to calculate his stop loss. He knows his strategy. So he knows everything. All right. And he knows that trading, sometimes can end in a loss. And he's not bothered about that, knowing that he has a good win rate, he has a good risk reward ratio, and at the end of every month, he's able to come out profitable. All right. Some months might not be so well. All right. Sometimes you can even have a win rate lesser than 40%. But in the long run, if you look at the picture of 1 month, 2 months, 3 months, and so on, you will now begin to understand how profitable trading can be. All right. So that's it. And if you love this video and if you think that it has helped you learn a few stuffs, do well to subscribe. There are many more videos that will be coming up like this one that's going to change how you see trading and help you become a better trader. Don't forget, we are the winning traders. All right, have a wonderful day, and I will see you in the next video. Take care.